Ladies and gentlemen, thank you for joining me today as we explore one of the most anticipated economic events of this year. The Federal Reserve stands at a critical juncture as it prepares for what many analysts believe will be a rate cut at its final meeting of 2025. This decision carries profound implications for every American household, every business, and indeed, the global economy. Over the next hour and a half, I want to walk you through what's happening, why it matters, and what we can expect in the days and weeks ahead. Let me begin by setting the stage. We're now in December 2025, and the Federal Reserve has been navigating one of the most challenging economic environments in recent history. For the past several years, the Fed has been engaged in a delicate balancing act, trying to control inflation while maintaining employment and supporting economic growth. The decisions made at this upcoming meeting will signal the Fed's confidence in the progress we've made and its vision for where we're headed. The context is crucial here. We've witnessed a remarkable journey since the inflation surge that began in 2021. The Federal Reserve responded aggressively, raising interest rates at a pace we hadn't seen in decades. The federal funds rate, which determines borrowing costs throughout the economy, climbed from near zero to levels that put significant pressure on consumers and businesses alike. Those rate hikes worked, but they came with costs. Higher mortgage rates made homeownership less affordable. Credit card debt became more expensive to service. Business loans became harder to justify. But inflation did come down. Now, as we approach this final meeting of 2025, the economic landscape has shifted. Inflation, while still a concern for many families at the grocery store or gas pump, has moderated significantly from its peak. The labor market, which remains surprisingly resilient throughout the tightening cycle, is showing signs of cooling. Not collapsing, mind you, but cooling in a way that suggests the economy is finding a more sustainable equilibrium. This is the environment in which the Federal Reserve must make its decision. The Reuters report suggests that the Fed is poised to cut rates. Notice the language there. Poised. Not guaranteed, not certain, but poised. This distinction matters because the Federal Reserve operates in a world of probabilities and data dependency. They're constantly analyzing incoming information, adjusting their models, and recalibrating their expectations. What looks likely today could change if we receive unexpected data in the coming days. But let's assume for our discussion that the cut does indeed materialize. What would drive such a decision? The Federal Reserve has a dual mandate from Congress. They're tasked with promoting maximum employment and stable prices. For the past few years, the emphasis has been heavily on the price stability side of that equation. Inflation was the enemy, and higher interest rates were the weapon of choice. But as inflation has retreated, attention shifts back to employment and growth. The Fed will be looking at several key indicators as they make their decision. Employment data is paramount. If job growth is slowing more than expected, if unemployment is ticking upward, if wage growth is decelerating rapidly, these are signals that the economy might need support. The Fed doesn't want to engineer a recession. They want what's called a soft landing, where inflation comes down without causing widespread job losses and economic pain. Consumer spending data also plays a critical role. Americans drive about 70% of economic activity through their spending. If consumers are pulling back significantly, if retail sales are weakening, if confidence surveys are dropping, the Fed takes notice. They understand that sustained economic health requires consumers to feel secure enough to spend money. Business investment is another crucial metric. Companies make hiring and expansion decisions based on their economic outlook and the cost of capital. If high interest rates have caused businesses to delay investments, cut back on hiring plans, or defer expansion projects, a rate cut could help unlock that pent-up activity. The Fed will be examining surveys of business sentiment, capital expenditure plans, and actual investment flows. The housing market deserves special attention. Residential construction and home sales are incredibly sensitive to interest rate changes. Mortgage rates, which loosely follow the Fed's policy rate, have kept many potential homebuyers on the sidelines. A rate cut would likely lead to lower mortgage rates, potentially reviving a housing market that has been largely frozen. This matters not just for construction workers and real estate agents, but for all the industries that supply the housing sector, from appliances to landscaping to furniture. Financial conditions more broadly will factor into the Fed's thinking. This is a somewhat abstract concept, but it essentially captures how easy or difficult it is to borrow money across the economy. When financial conditions are tight, credit is expensive and hard to obtain. When they're loose, money flows more freely. The Fed will assess whether current financial conditions are tighter than necessary to maintain stable inflation, and if so, a rate cut would be warranted. International considerations cannot be ignored. The United States doesn't exist in economic isolation. What happens in Europe, in China, in emerging markets, all of these developments ripple through to the American economy through trade, capital flows, and exchange rates. If global growth is slowing, if other major central banks are cutting rates, if there are financial stresses in important trading partners, the Fed might decide that some monetary policy support is appropriate. Now, let's talk about the meeting itself and how this decision will unfold. The Federal Open Market Committee, known as the FOMC, is the body within the Fed that sets interest rate policy. It consists of 12 voting members, including the 7 governors of the Federal Reserve Board and 5 of the 12 regional Federal Reserve Bank presidents. These individuals bring diverse perspectives from different parts of the country and different areas of expertise. The meeting typically spans 2 days, though the actual deliberations occur on the second day. In the days leading up to the meeting, the committee members receive extensive briefing materials. Teams of economists at the Federal Reserve Board in Washington and at the regional banks compile reports on every aspect of the economy. They analyze recent data, update forecasts, and present alternative scenarios. The depth of this analysis is truly remarkable. These are some of the most sophisticated economic minds in the world, supported by vast amounts of data and powerful analytical tools. On the first day of the meeting, staff economists present their assessments. They walk through the economic outlook, discuss risks, and present policy recommendations. Committee members ask questions, probe assumptions, and debate interpretations. This isn't a rubber stamp process. These are serious deliberations where disagreement is common and healthy. The second day is when policy decisions are made. Committee members go around the table, each presenting their views on what policy should be. Some will advocate for a rate cut, perhaps arguing that inflation is sufficiently under control and that supporting growth and employment should now take priority. Others might argue for holding rates steady, concerned that cutting too soon could reignite inflation or that the economy doesn't really need additional stimulus. In this particular meeting, if the consensus is leaning toward a cut, the debate will center on the magnitude. Should it be a 0.25 percentage point, which would be 25 basis points in Fed terminology? Or should it be more aggressive, perhaps 0.5 percentage point? The size of the cut matters enormously. A 0.25 point signals confidence that the economy is on the right track but could use a modest boost. A 0.5 point cut would suggest more concern about economic weakness and a desire to provide more substantial support. There's also the question of forward guidance. This is how the Fed signals its intentions for future meetings. The statement released after the meeting will be parsed word by analysts trying to understand what comes next. Will the Fed indicate that more cuts are likely in 2026? Will they suggest that this is a one-time adjustment and they'll then pause to assess? Or will they maintain optionality, keeping their options open depending on how the data evolves? The projections that accompany the meeting are equally important. 4 times a year, including at this December meeting, the Fed releases something called the Summary of Economic Projections. This document shows where each committee member thinks interest rates should be at the end of 2025, 2026, 2027, and over the longer run. It also includes their forecasts for GDP growth, unemployment, and inflation. These projections give us insight into how the Fed sees the economy evolving and how they expect to respond. What's particularly interesting this time is that we'll see whether the committee has shifted its outlook since the previous projections in September. If we see a meaningful downward shift in the projected path of interest rates, that would signal that the Fed expects to cut more aggressively in the coming year. If the shift is modest, it suggests they're being more cautious. The press conference following the meeting is where the Fed chair will explain the decision and take questions from reporters. This is a crucial moment for understanding the Fed's thinking. The prepared statement is carefully crafted and often deliberately vague to maintain flexibility. But in the question and answer session, journalists can probe specific concerns and sometimes elicit more revealing responses. Watch for how the chair characterizes the inflation outlook. Do they express confidence that inflation is on a sustainable path back to the 2% target? Or do they hedge, noting that progress has been good but that risks remain? The language matters. Markets move on nuances in these communications. Similarly, listen for how they describe the labor market. Is it cooling in a healthy way, or are there concerning signs of weakness? The Fed has been hoping for a gradual cooling that brings supply and demand into balance without triggering widespread layoffs. If they believe that's happening, it supports the case for rate cuts. If they're worried about the cooling going too far, they might cut more aggressively. Let's consider the various scenarios that could play out. The base case, the scenario most analysts expect, is a quarter-point rate cut. This would bring the federal funds rate down by 25 basis points. The Fed would frame this as a recalibration of policy to account for lower inflation and a moderating economy. They would likely signal that they're not on a predetermined path, that future decisions will depend on incoming data, but that they see the risks as more balanced than they were when rates were being raised. In this scenario, markets would likely respond positively but not dramatically. Stock markets might rally modestly on the news, seeing it as supportive of continued economic growth without signaling serious concern. Bond yields might decline slightly, reflecting expectations of lower short-term rates ahead. The dollar could weaken a bit against other currencies, making American exports more competitive. Mortgage rates would probably drift lower over the following weeks, though the effect wouldn't be immediate or dramatic. For ordinary Americans, a quarter-point cut in this scenario would have subtle effects. Someone with a variable rate loan or a home equity line of credit tied to the prime rate would see their interest costs decline slightly. Someone shopping for a car loan or a mortgage might find slightly better terms available. Savers, on the other hand, would see the yields on their savings accounts and certificates of deposit edge lower. The effects are real but modest. Now consider a more aggressive scenario. What if the Fed cuts by half a percentage point, 50 basis points? This would be a stronger signal that the Fed sees economic risks and wants to provide more substantial support. Such a move would likely be accompanied by language indicating that the Fed believes it's appropriate to shift policy more quickly toward a neutral stance, neither restrictive nor accommodative. Markets would react more dramatically to a 50 basis point cut. Initially, you might see a significant rally in stocks, as investors interpret the move as the Fed riding to the rescue of the economy. But there could also be an undercurrent of concern. Is the economy weaker than we thought? Does the Fed know something we don't? Sometimes aggressive rate cuts can actually spook markets rather than reassure them. Bond markets would definitely move on a 50 basis point cut. Yields would fall more substantially, and the yield curve might steepen as expectations for future short-term rates decline. Mortgage rates could drop more noticeably, potentially bringing buyers back into the housing market more quickly. The dollar would likely weaken more substantially, which has mixed effects. It helps exporters and domestic manufacturers competing with imports, but it makes foreign goods and overseas travel more expensive for Americans. For households and businesses, a larger cut would have more tangible effects. Borrowing costs would decline more noticeably. Refinancing mortgages would become attractive for more homeowners. Businesses might accelerate investment plans, seeing both lower financing costs and a Fed willing to support growth. But again, some might wonder if the Fed's actions reflect concerns about economic weakness that should make them more cautious. There's also a third scenario we should consider, though it seems less likely based on the Reuters report. What if the Fed decides to hold rates steady, no cut at all? This could happen if the incoming data between now and the meeting shows unexpected strength in inflation, or if the economy appears more robust than anticipated, or if financial conditions have already loosened enough on their own. A decision to hold rates steady when markets are expecting a cut would certainly surprise investors. We'd likely see a negative reaction in stock markets, at least initially, as rate cut expectations get dashed. Bond yields might rise. The dollar would probably strengthen. The Fed would need to communicate very carefully about why they're pausing and what it would take to trigger cuts in the future. Beyond the immediate decision, we need to think about the broader trajectory of monetary policy. Where are we in this rate cycle? Are we at the beginning of a sustained easing campaign, or is this more of a mid-cycle adjustment? The answer depends significantly on the underlying health of the economy and the trajectory of inflation. If inflation continues to moderate toward the Fed's 2% target, and if the labor market remains healthy but balanced, we could see a series of rate cuts over 2026. The Fed might want to bring rates down to what they consider a neutral level, somewhere around 3 to 3.5% by most estimates. That's the level where policy is neither stimulating nor restraining the economy. But if inflation proves stickier than expected, if price pressures re-emerge, the Fed might cut once or twice and then pause. They learned a painful lesson in the late 1970s and early 1980s when premature declarations of victory over inflation led to policy mistakes. They don't want to repeat that error. Fed Chair has repeatedly emphasized that they need to see sustained progress on inflation before feeling comfortable that the job is done. The labor market dynamics are particularly interesting to consider. We've had a remarkable period where unemployment stayed low even as the Fed raised rates aggressively. This defied many economists' predictions. The question now is whether we can maintain solid employment as the economy continues to adjust. Some cooling in job growth is normal and even desirable after a period of extremely rapid hiring. But there's a fine line between healthy normalization and the beginning of a more serious downturn. One aspect that doesn't get enough attention is the lag in monetary policy effects. When the Fed changes interest rates, the full impact on the economy takes time to materialize. Economists often say that monetary policy works with long and variable lags. Some effects are relatively quick. Credit card rates adjust within a billing cycle or two, but other effects take much longer. A business might take 6 months to a year to adjust its investment plans in response to rate changes. The housing market responds over many months as buyers and sellers adjust their expectations. This means that the rate increases the Fed implemented in 2022 and 2023 are still working their way through the economy. Some of the economic slowing we're seeing now isn't due to current policy but rather to past rate hikes finally having their full effect. This is why the Fed might feel comfortable cutting rates even if inflation isn't all the way back to 2%. They're accounting for the additional cooling that's still in the pipeline from previous policy. Let's talk about the international dimensions for a moment. Central banks around the world are all dealing with similar post-pandemic dynamics, though at different stages and with different intensities. The European Central Bank has been navigating its own challenges with inflation and growth. The Bank of England has dealt with unique pressures related to Brexit and energy costs. Central banks in emerging markets have faced even more complex situations, balancing domestic concerns with the effects of a strong dollar and capital flows. If the Federal Reserve cuts rates, it affects these other economies through multiple channels. A weaker dollar makes it easier for emerging markets to service dollar-denominated debts. Lower U.S. rates can reduce pressure on other central banks to keep their own rates high to prevent capital flight. On the other hand, if the Fed cuts while other major central banks don't, it could lead to currency movements that create their own challenges. The financial markets are a universe unto themselves in terms of how they'll respond. We've already discussed stocks and bonds, but consider the derivatives markets, the foreign exchange markets, the commodity markets. All of these are interconnected, and all respond to Fed policy. Traders position themselves ahead of Fed meetings based on their expectations. When the actual decision differs from those expectations, even slightly, it can trigger significant market movements. One phenomenon we might see is what's called a buy the rumor, sell the fact reaction. If markets have already priced in a rate cut, meaning they've already bid up stock prices and bid down bond yields in anticipation, the actual announcement might lead to a sell-off as traders take profits. Conversely, if markets are uncertain, a clear decision with forward guidance might reduce uncertainty and lead to a rally. Gold and other commodities often respond to Fed policy through their relationship with the dollar and with real interest rates. Lower nominal rates, if inflation expectations remain stable, mean lower real rates, which typically supports gold prices. Oil and other commodities can be influenced by the dollar's value and by expectations about economic growth. For corporate America, the Fed's decision has broad implications. Chief financial officers are watching carefully because it affects their cost of capital. Should they accelerate borrowing plans if rates are coming down? Should they adjust their capital structure, perhaps refinancing existing debt at lower rates? How should they think about expansion plans and hiring? Small businesses face similar questions but often with more urgency. Many small companies rely on lines of credit that are directly tied to the prime rate, which moves in lockstep with the Fed's policy rate. A rate cut provides immediate relief on interest expenses. It might make that equipment purchase more affordable or that expansion loan more feasible. The real estate sector deserves deeper examination. Commercial real estate has been under pressure for multiple reasons. The shift to remote work affecting office demand, high interest rates making financing expensive, and concerns about property valuations. A rate cut could provide some relief, though it won't solve structural issues like excess office space in certain markets. Residential real estate, as mentioned earlier, would likely see renewed activity with lower mortgage rates bringing buyers back into the market. Let's consider the political dimensions, though the Fed strives to remain independent of political pressure. We're in a politically charged environment, and decisions made by the Federal Reserve inevitably attract political commentary. Some politicians will welcome a rate cut, seeing it as support for workers and families. Others might criticize it as inflationary or as bailing out financial markets. The Fed's independence is crucial precisely because it allows them to make decisions based on economic analysis rather than political expediency. The Fed chair has consistently defended this independence, noting that the central bank's credibility depends on the public's belief that decisions are driven by the dual mandate, not by political considerations. This credibility is hard-won and easily lost. It's why the Fed is so careful about its communications and why it grounds every decision in economic data and analysis. Looking at household finances, a rate cut has mixed effects depending on your situation. If you're a borrower, particularly with variable rate debt, you benefit from lower interest costs. If you're saving for retirement or living off interest income, you face lower returns on safe investments like savings accounts and bonds. This is one of the inherent trade-offs in monetary policy. What helps one group can hurt another. Young families trying to buy their first home would generally benefit from lower mortgage rates. The affordability calculation changes meaningfully when rates drop even half a percentage point. On a $300,000 mortgage, a half-point rate reduction could save someone over $100 per month in interest. Over the life of the loan, that's tens of thousands of dollars. Retirees living on fixed incomes face a different calculation. Many have been enjoying relatively high yields on savings after years of near-zero rates. A return to lower rates means less interest income. However, if they hold bonds purchased when rates were higher, the value of those bonds would increase as rates fall, which could be beneficial if they need to sell. The credit card industry will adjust rates quickly in response to Fed changes. Most credit cards have variable rates tied to the prime rate. A Fed rate cut means lower interest charges for people carrying balances. Given that many Americans carry credit card debt month to month, this can provide meaningful relief. Even a quarter-point reduction across billions of dollars in outstanding credit card debt translates to significant savings for consumers. Auto loans are another major category of consumer credit. Car buyers might find financing more attractive with lower rates. This could provide a boost to an auto industry that's been dealing with various challenges, from supply chain issues to the transition to electric vehicles. Dealerships watch Fed decisions closely because they know financing costs significantly influence buyers' decisions. Student loans present a more complex picture. Federal student loans have fixed rates set by Congress, so they won't be directly affected by Fed rate cuts. But private student loans, especially those with variable rates, would see their costs decline. Graduates burdened with student debt would see some relief in their monthly payments. The banking sector itself faces interesting dynamics when the Fed cuts rates. Banks' net interest margins, the difference between what they earn on loans and what they pay on deposits, tend to compress when rates fall. They earn less on their loan portfolios, and while they can reduce what they pay depositors, competition limits how much. However, lower rates can also stimulate loan demand and reduce defaults, which benefits banks. The net effect depends on many factors specific to each institution. For the technology sector and growth stocks more broadly, lower interest rates are generally viewed as positive. These companies are often valued based on their future cash flows, and lower discount rates make those future profits more valuable in today's terms. This is part of why tech stocks often rally when rate cuts are announced or anticipated. The energy sector has its own relationship with Fed policy. Lower rates can support economic growth, which tends to increase energy demand. But energy prices are also influenced by global supply dynamics, geopolitical events, and the ongoing energy transition. A Fed rate cut is just one factor among many. Manufacturing and industrial companies watch Fed policy closely because it affects both their borrowing costs and the overall demand environment. If rate cuts help support economic growth, it means more demand for their products. If cuts lead to a weaker dollar, it makes their exports more competitive globally. The agriculture sector, though often overlooked in these discussions, is affected through multiple channels. Farmers often carry significant debt for equipment, land, and operating expenses. Lower rates reduce these borrowing costs. Exchange rate movements affect agricultural exports. And broader economic conditions influence commodity prices. Let's think about the international capital flows that respond to Fed policy. When U.S. interest rates decline relative to rates elsewhere, it can reduce the attractiveness of dollar-denominated assets to foreign investors. This can lead to capital outflows from the U.S. and inflows to other countries with relatively higher returns. However, the U.S. dollar status as the world's reserve currency and the depth and liquidity of U.S. financial markets means that even with lower rates, demand for dollar assets remains strong. Emerging market economies are particularly sensitive to Fed policy changes. During periods when the Fed was raising rates and the dollar was strengthening, many emerging markets faced difficult choices. If they didn't raise their own rates to prevent capital flight, they risked currency depreciation and inflation. If they did raise rates, they slowed their own economic growth. A Fed rate cut eases some of these pressures, allowing emerging market central banks more flexibility in their own policy decisions. The cryptocurrency market, while still relatively young and volatile, also responds to Fed policy. Lower interest rates tend to be viewed as positive for risk assets generally, and cryptocurrencies often move with this risk appetite. Additionally, some crypto advocates see low rates and monetary easing as validation of concerns about fiat currency and inflation, though the relationship is complex and evolving. Private equity and venture capital sectors have been significantly affected by higher interest rates over the past few years. Valuations came under pressure, and exits through IPOs or acquisitions became more challenging. A rate-cutting cycle could reinvigorate these markets, making it easier for private companies to raise capital and for private equity firms to finance deals. The municipal bond market, which finances infrastructure and services for state and local governments, would likely see lower yields if the Fed cuts rates. This could make it cheaper for cities and states to finance schools, roads, water systems, and other public investments. In a time when infrastructure needs are substantial, this could have meaningful real-world effects on communities. Pension funds face ongoing challenges in a lower-rate environment. Many public and private pension plans have obligations to pay retirement benefits far into the future. Their ability to meet these obligations depends on the returns they can earn on their investments. When risk-free rates are lower, pension funds either need to take more risk to achieve their return targets or face funding shortfalls. This is a long-term challenge that a single rate cut doesn't solve, but it's part of the broader context. Insurance companies, particularly life insurers, face similar challenges. They have long-term liabilities, the policies they've sold, that they need to match with assets that generate sufficient returns. Lower rates make this matching more difficult. This is why insurance companies often advocate for higher rates, even though that might seem counterintuitive. The housing affordability crisis that's been building in many American cities could see some relief from lower rates, though the underlying issue is primarily about supply, not just financing costs. In markets where home prices have soared, making monthly payments more affordable through lower mortgage rates helps, but it doesn't solve the fundamental problem of too few homes available for too many buyers. Climate change and the energy transition represent a massive investment need in the coming decades. The cost of capital matters enormously for these investments. Solar farms, wind turbines, electric vehicle charging infrastructure, building retrofits, all of these require upfront capital that pays back over many years. Lower interest rates make these investments more economically attractive and could help accelerate the transition. Small business formation and entrepreneurship are influenced by the availability and cost of capital. When someone wants to start a business, they typically need to borrow money for equipment, inventory, and working capital. Lower rates make this more feasible. In an economy that depends on innovation and new business creation for long-term growth, this effect of monetary policy shouldn't be underestimated. The gig economy and freelance work have become increasingly important parts of the labor market. These workers often don't have access to employer-provided benefits and may rely on personal credit for managing cash flow fluctuations. Changes in credit costs affect them directly. Lower credit card rates or personal loan rates can make a meaningful difference to someone whose income varies month to month. Healthcare costs, already a major concern for many Americans, don't have a direct relationship with Fed policy, but there are indirect effects. Hospitals and healthcare systems carry debt for facilities and equipment. Lower borrowing costs can help with their financial challenges. Medical device companies and pharmaceutical firms make investment decisions influenced by the cost of capital. Education financing, beyond student loans, includes debt carried by universities and school districts. Many educational institutions took on debt for construction and improvements during the low-rate environment of the 2010s. As that debt needs to be refinanced, a lower-rate environment would help manage costs, potentially putting less pressure on tuition increases or property tax rates. The arts and cultural institutions, from museums to theater companies to symphonies, often rely on endowments for support. These endowments need to generate returns to fund operations. Lower interest rates affect both what they can earn on safe investments and the valuations of their other holdings. While this seems far from the concerns of monetary policy, it's another example of how Fed decisions ripple through every aspect of society. Non-profit organizations more broadly face similar challenges. Many have endowments or reserves that need to generate income. Lower rates mean less income from safe investments, potentially forcing difficult choices about programs and services. On the other hand, if they have debt, their interest costs would decline. The military and defense sector might seem disconnected from Fed policy, but defense contractors make long-term investment decisions about facilities and research and development that are influenced by capital costs. The government's own borrowing costs for defense spending are also affected, though the government's fiscal decisions involve many other considerations beyond just interest costs. Let me take a moment to address some common misconceptions about Fed policy. First, many people think the Fed directly sets mortgage rates or credit card rates. That's not quite right. The Fed sets the federal funds rate, which is what banks charge each other for overnight loans. Other rates are influenced by this but also by market forces, credit risk, term premiums, and competitive dynamics. Second, there's often confusion about how quickly rate changes affect the economy. As I mentioned earlier, there are significant lags. Don't expect to see dramatic changes in employment or inflation in the month immediately following a rate decision. The effects build over time. Third, some people think the Fed can fine-tune the economy with precision. The reality is much messier. The Fed is working with imperfect information, uncertain models, and an incredibly complex economy. They do their best to make decisions that move things in the right direction, but there are always uncertainties and unexpected developments. Fourth, there's sometimes a belief that the Fed's primary concern is the stock market. While the Fed certainly pays attention to financial markets as a source of information about economic expectations and as a channel through which policy affects the economy, the stock market is not their mandate. Their focus is on employment and inflation. As we look toward the decision expected in this upcoming meeting, it's worth reflecting on just how far we've come since the pandemic disrupted everything in 2020. The economic response to COVID, both fiscal and monetary, was unprecedented in scale. The Fed cut rates to zero, purchased trillions of dollars in bonds, and created emergency lending facilities. The government sent checks to households and provided support to businesses. That response prevented a deeper economic catastrophe, but it also contributed to the inflation we experienced as the economy reopened with supply chains disrupted and demand surging. The Fed's subsequent rate hiking campaign was necessary to bring inflation back down, even though it caused pain for borrowers and worried many about recession. Now, potentially preparing to cut rates, the Fed would be signaling confidence that inflation is under control enough to focus more on supporting growth and employment. This would mark a new phase in the post-pandemic economic story, one where we're moving toward something resembling normal policy rather than the extremes of either near-zero rates or aggressive tightening. The human element in all of this shouldn't be forgotten. Behind all the economic data and policy decisions are real people making real choices about their lives. The family trying to decide if they can afford a home. The small business owner wondering whether to hire another employee. The worker worried about layoffs. The retiree trying to make savings last. The graduate burdened with debt. Fed policy touches all of these lives. This is why the Fed takes its responsibility so seriously. The officials making these decisions are not cavalier with their power. They understand that their choices affect millions of people. They spend countless hours analyzing data, debating scenarios, and trying to make the best decisions possible with the information available to them. As we await the meeting's outcome, remember that whatever happens represents the Fed's best judgment at this moment about what serves the dual mandate of maximum employment and stable prices. They will explain their reasoning, provide their updated forecasts, and signal their thinking about the future. Markets will react, analysts will dissect every word, and the economic wheels will continue turning. The most likely outcome, a quarter-point rate cut, would represent a modest but meaningful step toward policy normalization. It would signal that the fight against inflation, while not complete, has progressed enough to allow some easing of restrictive policy. It would provide modest support to an economy that has proven remarkably resilient but faces real challenges. And it would set the stage for further policy evolution in 2026 depending on how the data develops. Whatever happens at this meeting, it won't be the end of the story. The economy will continue evolving. New data will arrive. Unexpected events will occur. The Fed will need to continue adapting its policy to changing circumstances. This is the nature of monetary policy, an ongoing process of assessment and adjustment in service of the American economy and the people whose livelihoods depend on it. Thank you for your attention through this detailed examination of one of the most significant economic events of the year. The decisions made at this Federal Reserve meeting will reverberate through the economy in the months ahead, affecting borrowing costs, investment decisions, employment prospects, and financial markets. By understanding the context, the considerations, and the potential outcomes, we can better navigate whatever lies ahead and make more informed decisions in our own financial lives. The Federal Reserve's final meeting of 2025 represents not an ending but a transition, one more chapter in the ongoing story of how monetary policy shapes our economic destiny. Claude is AI and can make mistakes. Please double-check responses.